Last month, I sat down and I did something that I've actually never done before. I went through the entire process of selling a home and buying another one at the same time, as if a normal person with no mortgage background were to do this. No shortcuts, no industry contacts, no insider knowledge. I wanted to see what it actually feels like to navigate this as a regular homeowner. And I made a list of every moment of confusion, everything that didn't make sense, every question I couldn't easily answer. The list has 12 items on it because here's what nobody tells you about selling your first home and buying your second one at the same time. It's not twice as hard. It's just a completely different animal. The decisions compound on each other. The timing can work against you in ways that you just don't even see coming. And there are at least 3 moments in the process where most people make a choice that costs them money, not because they're careless, but because nobody has actually explained it to them. And today I'm going to walk you through all of it. But first, my name is Daniel Solis. And if you're not subscribed to this channel, make sure you click that subscribe button because we're going to give industry insights that no one's talking about. I have helped people for over 10 years in this market, and I'm going to help people exactly through every situation they can walk through. And I will give you a plan, and it's going to be purposed. So let's get into it. The first question almost every move-up buyer asks is this: should I sell first or buy first? And I want to tell you right now that that's not actually the right question to start with, because the answer really depends on things that you probably haven't figured out yet. And if you pick a side before you have those answers, you'll spend the next 90 days either making panic decisions or sitting on your hands watching houses disappear. Here's the right question to start with. Do you know exactly what you can afford to buy, independent of what your current home actually sells for? Because there are 2 very different buyers in this situation. See, buyer A needs the equity from their current home for a down payment to go to the next one, that genuinely cannot close on the new house until the old one sells. Their timing is tightly linked. Buyer B has enough in savings, retirement, and other assets to put a down payment on their next home without touching the sale proceeds. Their sale and their purchase can technically happen independently. These 2 buyers have completely different strategies, completely different negotiating positions, completely different risk profiles. Most people don't even know which one they are until they sit down with a lender and actually run the numbers. This is where the process has to start. Not with Zillow, not with calling a real estate agent, with a lender who can tell you exactly what your financial picture looks like and what you're actually working with. Now, here's the first thing that surprised me when I actually walked through this process fresh. I looked at my Zillow estimate. Let's say the house shows $380,000. I owe $190,000. So roughly I have $190,000 in equity, right? On paper, yes. In my bank account, no. The equity doesn't become real money until the day you close on your sale. Until that moment, it's a number on a screen. And here's exactly what happens to that $190,000 between the estimate and closing. Well, real estate commissions, typically 2.5% to 3% to your agent. In many transactions, still some amount to the buyer's agent. On a $380,000 sale, you could be looking at $15,000 to $20,000 right off the top. Closing costs on the sales side, seller paid transfer taxes, title fees, settlement fees, HOA expenses, budget roughly 1% of the sales price for closing costs, and another $3,800 for repairs and concessions if the buyer's inspector finds issues and they request you to fix it. Now they might ask for credits, and that number comes down again. Pay off your existing mortgage. This is your principal balance plus the accrued interest through the payoff date. That $190,000 assumes a clean payoff. Your actual payoff might be slightly higher. When you run the real math, that $190,000 in Zillow equity realistically might net you $155,000 to $165,000. That's still a lot of money, but it's different than $190,000. And if you were to mentally plan on the $190,000 and that just changed, well, that might have changed your entire qualifying picture. You need to know your net proceeds, and I can run that number for you in about 15 minutes. Now, this is the part that catch most people off guard, and it caught me off guard even running through it theoretically. Let's say you're buyer A, your down payment is coming from the sale of your house. Your real estate agent gets you an offer, full price, clean terms, closes in 30 days. You're ecstatic. You're start looking at houses, you find the one you love, you put in an offer, and the seller's agent calls back and says, "Is this contingent on the sale of your current home?" Yes, it has to be. And in many cases, especially in a market where the seller has multiple offers, the answer is, well, we're just gonna pass. Contingent offers are not dead. They can absolutely work, especially if your home is already under contract, but they put you in a weaker negotiating position. And that window between when your current home goes under contract and when you need to identify the next one is narrower than most people expect. Roughly 2 to 3 weeks from the time your home goes under contract to get to your next home under contract. If you want both closings to happen close together, which is what most people want because carrying 2 mortgage payments simultaneously is not fun, that 2 to 3 week window means you should be looking at houses before you list, not after. The mental model most people have is list the house, get it sold, and then go shopping. That sequence makes the timing nearly impossible. The sequence that actually works, get your finances sorted, get pre-approved, start looking at homes, and you be willing to buy, list your home, go under contract, or both simultaneously, schedule closings 1 to 3 days apart. That's the move. It requires preparation, it requires nerve, it requires working with people who have done it before, and here's the first thing that surprised me when I walked through the process fresh. You know, I'm not a CPA, so talk to your tax professional about your specific situation, but I want to put this on your radar because I've met homeowners who didn't know it existed, and it's significant. If you lived in your home as your primary residence for the last 2 of the last 5 years, you may be eligible for capital gains exclusion on the profit of your sale. For a single filer, the exclusion is $250,000. For a married couple filing jointly, it's $500,000. Meaning, if you're a married couple and you bought your house for $200,000 and you sell it for $380,000, you made $180,000 in profit. Under the exclusion, that potentially 0 federal tax on that gain. That changes the math on whether you should wait or you should sell. And it changes how you should see and think about net proceeds. It's a real number. The requirements is a 2 out of 5 year residency rule. If you've ever been renting it out, if you moved out more than 3 years ago, or if your situation is complicated, talk to your CPA before you list. But if you're living there and it's your primary home, there's a very good chance that the equity you've built is going to land in your pocket tax-free. Again, verify with your tax professional, but know that that exists. Here's something that surprised me when I ran through this as a fresh buyer also. I assumed that because I was selling a home with equity and buying a new one, the lender would view me as a stronger borrower. That's not automatically true, and here's why. When you apply for the new mortgage, the underwriter looks at your current debt-to-income ratio. If you still own a current home when you apply, even if it's listed, even if it's under contract, that mortgage payment is still in your debt to income calculation. So if your current mortgage is $1,800 a month and the new house payment is going to be about $2,400 a month, the underwriter may look at you as someone with a $4,200 a month in housing obligation. That can knock you out of qualifying even temporarily. Of course, there are exceptions. If your current home is under contract and you can document it, many lenders, including us, can exclude the current payment from your debt to income or use projected rental income in certain scenarios. But of course, that's going to require documentation and proper structuring. This is one of the most important reasons to talk to your lender before you do anything else. Not after you find the house you want, not after you list your current home, but before any of that. Because the way that we structure your pre-approval determines what offers you can make and how strong your position is. I'd be doing a disservice to this audience if I didn't address this specifically. If you bought your first home with a VA loan, which a lot of Hampton Roads buyers do, you may be wondering what happens to that benefit when you sell and you buy again. The answer in most cases is your VA entitlement gets restored when you sell and you pay off the original VA loan. That means you can use your VA benefit again on a new purchase. No down payment, no PMI, the whole thing. There are 2 paths for this. One-time restoration, which is the standard process after you sell and pay off your original loan, and bonus entitlement, which in some cases allows you to use a VA loan on a new purchase even before the original is sold. If you have enough remaining entitlement and meet the occupancy requirements, this is a conversation worth having before you make any decisions. Because if you have VA eligibility and you're planning to put 5 to 10% down on a conventional loan, just because you think you used up all your VA benefit, you may be leaving a significant advantage on the table. So here's what I want you to take from this video. The move-up process, selling your first home and buying your second, is genuinely more complex than either transaction on its own. the timing, the equity math, the qualification structure, the contingency question. These things interact with each other in ways that catch prepared people off guard, let alone people going through it for the first time. The single best thing you can do before any of this starts is to sit down with a lender who knows the market, can actually run the numbers, not an online calculator, a real conversation. And if you're in Hampton Roads and you're in this situation thinking about selling, starting to look at what's next, the link to connect with me is in the description. I'll look at your current mortgage, your equity position, and what you can qualify for on the next house and give you a real picture of what this looks like for you specifically. No pressure, just clarity. And if this was helpful, hit that subscribe button. I make videos specifically for buyers and homeowners in Virginia Beach area with real information, real numbers, no fluff. And I'll see you on the next one.